Good morning, children. In the previous class, in the video, we have discussed important adjustments related to cash flow statement. And today, we are going to see a question from a textbook which takes a complete cash flow statement and adjustments coming up. Not all, but few adjustments coming up here. So, this is your question, and I'll show you the adjustments which are given here. So, adjustments which are part of this question is additional information. So this is adjustments. Number one, contingent liability. Under contingent liability, it is proposed dividend. For the previous year, it is 42,000. For the current year, it is 50,000. Then second adjustment says depreciation of rupees 10,000 and rupees 20,000 has been charged on plant, land and building respectively. That means depreciation on plant is 10,000, whereas depreciation on land and building is 20,000. Third adjustment is an interim dividend of rupees 20,000 has been paid. Next adjustment says income tax of rupees 35,000 has been paid. And the last one says rent received during the year is rupees 10,000. Children, out of this we have discussed adjustments related to point number B, C and D in our previous video, and today we are going to see its impact on the preparation of cash flow statement. So let us once give a glance to the questions. So here is equity and liabilities, shareholders fund, share capital, reserves and surplus, then current liabilities, trade payables, short-term provisions, and under short-term provision we have provision for tax. The discussion of this adjustment we did in the previous video when we prepared provision for tax ledger account. Then comes the assets. Assets has non-current assets, fixed assets. Fixed assets have tangible assets category and intangible assets category. Tangible assets, intangible assets with the note numbers. Then current assets has inventory, trade receivables, cash and cash equivalent. And then we have notes to accounts detail, which is starting with reserves and surplus. It has given you two subheads, general reserve and profit and loss balance. Then tangible assets is giving us land and building and plant. Intangible assets is talking about goodwill and the additional information which we discussed just now. Now let us see our cash flow statement for this question. So children, if you will relate to the question, the first thing is profit before tax. And profit before tax has been done in the working notes. So if we see the working notes in the profit before tax calculation, this is the starting point where the previous year profit is 30,000, that is 2017 profit 30,000, and current year 2018 profit is 48,000. So the net profit for the year is 18,000. Now we add in this few heads which are part of treatment here in the working notes in the calculation of net profit before tax and extraordinary items. So what has been added here? Previous year proposed dividend of 2017, 42,000. Remember, we have no treatment for current year proposed dividend, but the previous year proposed dividend is to be added back to the net profit. Then the interim dividend paid is also added to the net profit, 20,000. Transfer to general reserve. This was just now we have seen it in the notes to accounts. So increase in general reserve from previous year to current year is 30,000, which is added here. And provision for taxation, the discussion we did in the previous video, this is provision for tax made during the year, and this 45,000 is coming by preparing the provision for taxation account. We will go and discuss about it. So in this question, the heads of balance sheet are known to you. Where will a particular item from balance sheet go in the cash flow statement? My focus is on the preparation of ledgers which are a part of adjustment. So the first ledger is here, land and building account. So how do we prepare it? Whenever you have to prepare an asset account, we have seen in the previous video, we have to take the previous year balance on the debit side. This is two balance brought down. 2 lakh is the amount given in the question for 2017, which is a previous year. So you write it directly here. Then the current year amount of land and building is 1,70,000, which again comes from your balance sheet in the question. This is 2018 value of land and building. Then in our adjustments, it was given, I'll show you here. In our adjustment, it was saying depreciation 10,000 and 20,000 on plant, land and building. So we are in the ledger of land and building. So we will write this depreciation amount from the question here by depreciation, or they have written it here, statement of profit loss. We can also write by depreciation 20,000. So this gives us the balancing figure 10,000, because the debit side 2 lakh is more than the credit side 1 lakh 70 plus 20, which is 190. So the balancing figure is 10,000. And whenever the balancing figure is coming in the asset account credit side, this is sale of asset, because depreciation was already given. Now, how will you treat this in cash flow statement? This sale of asset will be an inflow of cash in your investing activities. I repeat, sale of asset will be an inflow of cash in investing activity, and depreciation 20,000 will be added in the operating activity to non-cash expenses. So these are the two amounts which will go from this ledger to your cash flow statement. So I'll show you both these amounts. So let us go to operating activity and see where depreciation is shown. So here it is depreciation on land and building 20,000, and similarly depreciation on plant is also written here 10,000. I hope this is clear. Now let's go back to our adjustments and see your second ledger. The second ledger is plant account. Same explanation. Opening balance, that is previous year 2017, is shown on the debit side. Then the closing balance, that is current year amount 2 lakh, is shown on the credit side. This comes from your balance sheet. The question has given you depreciation, so this will come on the credit side by depreciation 10,000. And in this ledger, credit side total is 2 lakh 10,000, whereas the posting on the debit side is 80. So the balancing figure is 130, and this is plant purchase. The entry is plant account to bank account. This is the balancing figure. Now, this purchase of plant will be an outflow of cash in investing activity, so it will be subtracted in investing activity. So let us go in investing activity and see both the amount. You see here purchase of plant 1,30,000. This is subtracted. This is a negative figure, whereas land was sold, so sale of land is a positive figure, which is 10,000. So this is added. This is subtracted. I hope you have got my point. Now let us see the next ledger, which is provision for taxation account. So you see this ledger. Now where is the amount coming from? This balance BD is coming from your question under provision for taxation. The previous year amount is 40,000, 2017 amount from the question in the notes to account, and then the current year figure is written here to balance CD. This is current year provision for taxation amount 50,000. So these two amount comes from the question. Now let us see what is the adjustment given in the question. The adjustment language says income tax of 35,000 has been paid. So I've explained you in the video in the previous class that when income tax is paid, the entry is provision for taxation account to bank account. So this should go on the debit side of provision for taxation account to bank account, tax paid 35,000. Now the debit side has a total of 85,000, whereas there was a posting of 40. So the balancing figure is 45,000. This is provision for tax made during the year. So we write by statement of profit and loss, provision for tax made during the year. This amount of provision for tax made will be added to your net profit in your extraordinary items calculation, and this tax paid 35,000 will be resulting into outflow of cash, and it will be subtracted in operating activity when we close our operating activity, and from which amount this will be subtracted? It will be subtracted from cash generated from operations. This we have discussed in a previous class regarding the treatment of tax paid 35,000 and provision for tax made 45,000. Now I will show you these two amounts in your working and cash flow statement. So let us first go in the extraordinary items area and see how the calculation has been done. So you see here, provision for taxation 45,000. This is a tax made to the added to the profit. So this is treated here, and now we see where is tax paid shown. Tax paid is shown towards the end. You see here cash generated from operating activities 150. This is also known as cash generated from operations. Then you subtract income tax paid 35,000, and your final answer is cash flow from operating activity 1,15,000. Now let us go into the next adjustment. The next adjustment in your question is rent received during the year, rupees 10,000. So the rent received during the year is a non-operating income, correct? And rent received is a part of investing activity. So we have to show it as an inflow of cash in investing activity, it will be added. And since it is a non-operating income, it will be subtracted in your operating activity. Less rent received 10,000. So first treatment is subtracted as a non-operating income under operating activity. And the second treatment is it is an inflow of cash in investing activity. This will be added. Rent received 10,000. So that is the treatment, children, of all adjustments. I hope the items of your balance sheet are pretty clear to you, how they go in your three activities. I haven't gone into detailed discussion of those heads, but whatever is the part of our adjustment, a new area for us, we have discussed, because in the previous video we completed discussing our adjustments related to cash flow statement, and some of the adjustments are already here in this question. Yeah, one more thing, children. In the question there was goodwill, and this we have already talked about. Goodwill is previous year 1,15,000 and it is decreasing to 90,000 in the current year. So any decrease in goodwill is goodwill written off, and this we have already discussed earlier, that goodwill written off is a part of your non-operating expense area where you write it under operating activities. So goodwill written off is 25,000 because it reduces your net profit. So after doing all the major postings, the first answer is cash flow from operating activity, which is coming as 1,15,000. Second is cash flow from investing activity, which is coming as minus 1,10,000. Third is cash flow from financing activity, which is coming as minus 12,000. When we do the sum of these three activities, the net decrease in cash and cash equivalent is coming minus 7,000. In the question, cash and cash equivalents in the beginning of the year, that is previous year, is given as 25,000. 25,000 minus 7,000 is 18,000, and this is your cash and cash equivalents at the end of the current year. And that is how this question has been done with the help of adjustments. And this is the first question which we have discussed in cash flow statement which has adjustments. So please revise it nicely, go through the video once more, understand your particulars, detail about it, and if you have any doubt, we can clear it in online class tomorrow and solve this question in your copy. Pick up more questions from your exercise book, from your book Exercises and Illustration, and let us go into a thorough practice of cash flow statement with adjustments from today onwards. So I hope this explanation of your textbook question has helped you. You will be having queries, so we will discuss it in online class tomorrow. Thank you. Take care. Have a nice day.